All right, well, let's go ahead and get started. We kind of got a lot to go through today. Hopefully this all makes sense to you and you get something good out of it. There are a lot of changes that have come about from this new piece of legislation that is effective as of now, signed at the end of the year by President Biden and had relatively bipartisan support. So I think that the net change from this will be positive, but just keep in mind that some things are a bit of a wait and see to see how they'll actually play out and how things will actually kind of come to play with regard to how it's going to actually affect you. Some things are kind of easy, when we're talking about contribution limit changes, but some things are a bit more theoretical, and we're kind of get into that. So again, if you do have any questions, make sure you type those into the chat box. All audio has been muted. If you would like a copy of the slides, feel free to grab them. I have attached them as a handout, or you can always reach me afterwards. I'll give you my contact information here in a minute. Okay, my name is Alex Perny. I've been with Advanta since 2012, so I have a good amount of experience doing this. I typically am the one that does the presentations when we have new pieces of tax law legislation. So I covered in depth the first iteration of the Secure Act, which was the large chunk of legislation or tax reform legislation that came out of the Trump administration, which had some good, had some bad. It's just like with any tax law changes, there's a good amount of difference. I also did the coverage on the CARES Act, which was the COVID relief legislation, and now I'm doing this one. So if you have any questions, I try to do my research as best as possible to answer those, and hopefully I can bring you some good information as well. If you have questions specifically for me, I am happy to answer those on a one-on-one basis. If you're a client, non-client, anywhere in between and want to reach out, please feel free to do so. My direct contact information is right there up on your screen, but if you're just listening to the audio, you can reach me directly on my phone, 727-754-9954, or you can reach me at Perny, that's APERNY, at AdvantaIRA.com. Now, we are not tax advisors, so I do need to give a bit of a disclaimer before we get started. This is definitely a trust but verify type of situation. If you have questions regarding your specific situation that you need actual advice on, I do encourage you to talk to a CPA or an attorney. I'm always happy to answer questions in the best that I can in an educational manner. But before you make any decisions that are going to impact you with regard to your taxation or anything like that, I always encourage people to talk with a qualified advisor. And to that point, Advanta IRA and our employees do not provide investment advice or endorse any investment products. All information and materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. So a few key points that I want people to take away today. Depending on what your reason for being here is, that could definitely be, a myriad of different things, but I think kind of the high level points that I want people to understand that is going to mostly affect you as the individual taxpayer, you as the investor, are going to be the changes to the IRA required minimum distribution and contribution changes. There is a lot of changes to 401k plans. Some of them are more aimed towards the large plan administrators and large employers, your Walmarts, your Walgreens, Microsoft, like big employers that have hundreds, if not thousands of employees, and how those plans are administered. But there's also been significant changes to individuals such as sole proprietors and single member LLCs with how they administer their solo 401k plans, and also simple IRAs and SEP IRAs as well. But in general, the employer sponsored plans or the ERISA plans, qualified plans, have had a significant amount of changes. We'll touch mainly on what is going to be focused on the individual investor. So again, sole proprietors, single member LLCs, what changes have had there. And I'll touch on some of the bigger points that I just happen to find interesting, for the research that I've done. And also there are new Roth opportunities, a big thing I'm really excited about, and also a little bit apprehensive about, and I'll kind of get into the apprehension on this as well, is how many more opportunities there are for individuals to invest in an after-tax fashion. Now, this is going to be really interesting with regard to contributions to IRAs, with regard to the catch-up changes, but also for things like SEP and simple IRAs, and we'll get into that in a minute of just how much some of these things have changed. And again, so if you do have any questions, please do feel free to fire those into the chat, and I will address those as they come up. So with that being said, let's go ahead and get started. So some of the big things that have changed with regard to required minimum distributions, those payments now begin at 73. So if you did not have a required minimum distribution last year and you were going to turn 72.5 this year, you can now delay that. So if you are 73, that is the year in which you have to start calculating your required minimum distribution. This will increase to 75 in 2033. It is not going up incrementally. We have this 10-year runoff to where it then in turn is going to be adjusted at 2033 for doing your required minimum distributions. Now, keep in mind, the RMDs are going to be for any of your pre-tax plans, and we'll get into some of the exciting news with regards to who doesn't have to take an RMD any longer. But just keep in mind that as of January 1 of this year, RMD ages have changed. And also keep in mind throughout this presentation, I'll do my best, and I try to double check everything, that there are certain changes that we're starting as of last Monday, January 1st of this year. Some are in 2024, some are going out into 2033. So I know it's kind of a lot to keep track of, and I did my best if you want the slides to have those enumerated appropriately. And I also did a podcast on this as well that had, some other things in there as well, a little bit of a different context on this. So if you want to listen to that, might be some additional information. But keep in mind that the dates for some of this stuff are not uniform. Everything, although this bill went into effect, some of these changes are not actually going to start affecting people until later dates. But again, so the RMDs have changed, at least the initial change this year, and they will in 10 years go up another 2 years to 75. So again, people are living longer, people are working longer. That's an effort to make sure that they have relief from starting to have to take required minimum distributions out of these plans. One thing that I've always been a little bit, let's just say, unhappy with regards to the IRS regulations have been penalties for failing to take a required minimum distribution. So a lot of people, if you are maybe not someone that pays attention to all tax regulations, and let's be honest, there are a ton of them out there and they are not the easiest things to keep track of. It might be easy to forget that you needed to take a required minimum distribution or didn't calculate your total RMD amount for all of your pre-tax retirement plans. Well, previously, and this is something that started this year, previously, if you failed to take a required minimum distribution, the total amount of required minimum distribution that you failed to take, you had to pay a 50% penalty. So if you failed to take $10,000 of required minimum distributions, you had to pay $5,000 in penalties, still take out the $10,000 and pay tax on the $10,000. So it's very easy to see why I think a lot of people would be not very pleased if they didn't take a required minimum distribution. And there was basically no relief for people. The IRS was too bad, so sad. You have to pay us 50% of that failed RMD amount. Now, this really affected disproportionately people that had lower RMDs. If you were someone that had $1,000 RMD, well, your retirement plan was pretty small, and it wagers to guess that these people were probably didn't make as much money or didn't earn as much money throughout their lifetime. So having to pay a 50% penalty on something like that would be a huge burden. Now, if you had a $100,000 required minimum distribution, it's probably a little bit easier for you to absorb a $50,000 penalty. But in any regard, no matter if you're on one end of the spectrum or the other, an extremely wealthy individual or a not as wealthy individual, having to pay half of your required minimum distribution and penalties is not something anyone was happy about. So something I think that was really done in the best interest of the taxpayers with this is that the required minimum distribution penalty, if you have one, has been halved. So now it is 25% of the total required minimum distribution amount if you missed it to be paid in a penalty, which I don't think anyone's necessarily happy about saying, oh, I have to pay a 25% penalty. But again, this is a very good step in the right direction. Further to that, they have offered additional relief. Most of the time with the IRS, if you self-report and say, hey, I made a mistake, penalties are significantly less. That's a general theme when it comes to a lot of retirement plan things and other types of tax issues. If you fail to issue a $5,500 for your 401k plan, there is, a steep penalty if you're found out to have not have done it, but a very mild penalty if you have self-reported it. They have they have legislated now a self-reporting clause for failure to take an RMD. So now the RMD, again, to review, has gone down from 50% penalty to a 25% penalty. But if the taxpayer in a timely manner refiles an amended tax return and effectively self-reports the missed RMD, the penalty is now only 10%, which falls in line with early distribution penalties and things like that, which again, I think is a big thumbs up to good legislation that is really going to help the taxpayer. Granted, you're still going to take the money out, still pay taxes on it, but you now do have an avenue to go through that is not 50%, and you can potentially get that down to 10% if you fail to take an RMD. The easy fix for this, understand you have an RMD. Basically, if you have any type of pre-tax retirement plan, you're going to have a required minimum distribution. The government hasn't seen taxes on that yet. Once you reach a certain age, they're going to want you to start taking it out so they can start generating tax revenue. So just keep that in mind. We do have a lot of relief when it comes to the penalties if you haven't taken an RMD. Another really good thing when it comes to RMD rules that I am so happy that they finally changed is now Roth 401k plans do not have a required minimum distribution. Previous to this year, and again, this is a change that happened as of 1/1/2023, is that the only plan that was exempted from a required minimum distribution was a Roth IRA. And it would wager to think in common thought processes that if you had a Roth 401k, well, that should be exempted from required minimum distributions as well. And again, I think that's where people kind of got into issues with not taking RMDs, is that they maybe didn't realize that they had a Roth 401k that had a required minimum distribution as well. Well, it did. Made no sense to me that you'd have one, but you did. However, that has changed. Now there is uniformity with regard to after-tax retirement plans such as Roth IRAs and Roth 401ks insofar as that they do not have a required minimum distribution. Again, simplifying things for easier to understand and more uniform rules, I think is going to make all of this stuff a lot better for taxpayers and investors. And also, I think it offers up a higher degree of flexibility for people that maybe want to use solo 401ks and especially Roth solo 401ks or 401ks in general, as they do offer additional tax benefits to some types of investments. I've had clients that specifically participate in a Roth 401k for the higher contribution limits and then in turn roll out to a Roth IRA because they have RMDs. Well, now you can leave it in the Roth 401k and it opens up things like debt leverage finance for real estate investing and being exempted from unrelated debt finance income tax, which, again, is a little bit of a higher level thing and maybe a really niche thing for investors. But, with us focusing on alternative investments and self-directed investments, I think, and I would hope some of the people will definitely get some benefit or see the benefit and how that can really affect you for your long-term investing goals. Especially if you want to invest in something that's highly illiquid, doing it in a Roth IRA, had a big benefit to the fact that you didn't have an RMD and didn't have to worry about breaking up something that was either restricted, highly illiquid, non-cash flowing, or just cumbersome in general to have to do a distribution of if you didn't have cash available. So making uniform the required minimum distribution rules between Roth IRAs and Roth 401ks, big thumbs up. That's going to help a lot of people. We also have new provisions for the cost of living adjustments for contribution limits on IRA accounts. And I'm going to get more into that in the following slide. But again, to the point of making sure that people kind of get a preface of what I'm going to be covering, that is going to be something that is a big benefit. And we'll break that down here in a minute. And then there have been massive changes to the catch-up contributions for traditional and Roth IRAs. That's a little bit more complex to break down, and we have a slide dedicated to that. And again, if you have any questions, please do make sure that you type those out into the chat box. Happy to answer anything. If you want something enumerated on a little bit more, or you'd like additional clarification on that. Here we go. So catch-up contribution limits explained. Starting in 2023 and 2025, we have some things that are going to be fundamentally changing how people contribute to Roth and traditional IRAs. And most of the time when I talk about fundamental changes with tax law, it's not necessarily a good thing. This one, however, I believe is going to be a huge benefit to a lot of people. And I really hope that people are paying attention to this because there is a small window to do this. So if you are coming up on this, definitely start planning, maybe setting money aside so that you can take advantage of this because it is a huge benefit and also kind of, again, fundamentally changes some things that have been in effect, at least with regard to Roth IRAs that have been in effect since Roth IRAs have been in existence. So traditional IRA and Roth IRA, just annual contribution limits. We had a cost of living adjustment of $500 coming into this year. So $6,500 or $7,500 starting this year. So you can't make a $6,500 or $7,500 for last year, but now those are the limits. We're pretty used to those type of COLA adjustments for contribution limits to IRAs. I don't think that really surprised many people. However, the big one is that beginning in 2025, individuals aged 60 to 63 will be allowed to contribute an additional $10,000 per year as a catch-up contribution to an IRA. That works out to $60,000 for a married household that can be plugged away over 3 years into a traditional or Roth IRA. I'm calling it the mega catch-up. I haven't really, found a better term for it, but mega catch-up sounds weird. Maybe I'll come up with something more catchy. But anyways, this mega catch-up that we're talking about has a few provisions in it. One is that individuals making over $145,000 in the preceding year have to make the contribution directly to an after-tax retirement plan, to a Roth IRA. Well, now this is, again, where one of those fundamental changes that I mentioned came into play, because previously, if you were a high wage earner, you could not make a Roth IRA contribution directly. You had to do the quote backdoor Roth contribution, which meant you contribute to a traditional IRA, then you have to convert that basis over to a Roth IRA, file Form 8606, and potentially get double taxed depending on how much income you made and what your underlying basis in that contribution was. So, because you're making a non-deductible traditional IRA contribution. So again, that is huge for the fact that it opens up the ability for people that are higher wage earners to make a direct Roth IRA contribution because of this mega catch-up provision in there. Now, if you make less than $145,000 in the preceding year, you can make it to traditional or Roth. So it opens up, again, a very large tax deduction for those that are maybe making a little bit less money. And I would think that you would be able to blend these. You don't have to make it as an all-or-one contribution push into these plans when we get to 2024 or 2025, but that's kind of remains to be seen. We haven't exactly seen some of the procedural notifications from the IRS yet on a lot of these items, and that's one of them, is that do you have to make the election to be all or nothing? Can you blend them a little bit? I would think for the fact that the IRS allows for you to make a mixture of Roth and IRA contributions that they would allow for that. But again, don't know the direct answer to that. And I want to try to only include basically the most factual information that we can in this. Let me just do one thing and I'll answer a few questions. And then cost of living adjustments will now be in $1,000 increments for contribution limits for IRAs as opposed to $1,000 as we've been used to. But I would assume that with that smaller increment that the IRS is going to be more in line with what the Federal Reserve is pegging for consumer pricing index or some type of other inflationary measures to better match what exactly is going on in real time with regard to cost of living to help people better adjust for retirement savings. Because as we've seen over the past few years, inflation and cost of living have become so much more dynamic and change so much more frequently that just an annual update of maybe a $500 or a couple $100, really isn't, looking at that on a little bit more micro level, I think is going to benefit people quite a bit. So before we get into the stuff that changed with simple IRAs, because that's a little complex, let me get into a few questions. Cheryl asked, why is it specific to ages 60 to 63? That's a great question. The IRS and their infinite wisdom and shaking that magic 8 ball came up with that number. I have no idea. I would assume it has something to do with the fact that, the general age of retirement is seen as 59 and a half. So they just rounded up to 60 and are giving people that are recently reaching the age of retirement the ability to have, again, a significantly higher catch-up limit. Because once you get to the age of 60, retirement is probably 3 to 7 years away. So I would assume that, without giving kind of the opportunity for higher wage earners just to ram through a bunch of contributions into a tax advantage plan, that they would just set a few-year window for that. Let's see. Ken asks, given that they are changing 401k Roth require minimum distributions to match IRA RMD rules, is there any possible changes coming to have a Roth IRA taxing of alternative assets capital? What? Is there any possible changes coming to have Roth IRA taxing of alternative assets capital gain to match the treatment given to individual 401k alternative asset accounts? I'm going to answer the best I can. I mean, the taxation treatment between alternative assets in retirement plans is going to be uniform, whether it's pre-tax or post-tax. As far as I would think to the question, and maybe if I'm not answering this correctly, type it in, but the taxation of the exemption of any taxation on retirement plan income for Roth IRAs and Roth 401ks has always been analogous. So you've always had the same treatment of that. So whether you're invested in an alternative asset with a Roth 401k or a Roth IRA, it's going to be taxed the same. The only difference would be is that if you have some type of, let's say, underlying debt issue. So if you invested in, let's say, a limited partnership that's investing into commercial real estate, or you bought debt leveraged real estate, yes, there is a specific type of tax called unrelated debt finance income tax that is specific to 401ks. That exemption is not offered to IRAs. I do not see that being offered to IRAs because that has more to do with plan treatment of pooled assets and omnibus accounts than it really does to the individual investor. So with that specific instance, I don't see that coming to fruition for the IRA. Not to get too far off track, that stuff is a big rabbit hole. Done whole presentations on that. So, and then say, and then Cheryl, follow up to that, will the the mega catch up only be in the year 2025? No, it's the indication is beginning in the year 2025. That is when that change is coming. So again, great questions. Let's keep rolling. So not a whole lot of people have simple IRAs, so I'm going to briefly cover this, and I won't really get too far into the weeds of a lot of other changes happening to simple IRAs because, one, they picked a horrible analogy for the IRA because simples are anything but simple. I know, terrible pun, but I'm required to make the joke. I feel it necessary. But in 2024, the annual simple IRA limit and catch-up contribution is increasing by 10% for employers who have no more than 25 employees. Employers with 26 to 100 employees will have the ability to offer higher deferral limits, provided that the employer gives 4% match to employees and deferral contribution or a 3% employer contribution. Again, I just put that in there because there was a change to it, a real big fundamental change in how this is done. And again, it's split up depending on the number of employees. I would think that probably not a whole lot of people on this call would be affected by it, but maybe someone else is catching this on our YouTube channel might find a benefit to it. So I wanted to plug it in there. So again, for those of you that are a little bit more visual, I wanted to put up the contribution limits on here as they, again, the cost of living adjustments have changed a bit. So your traditional and Roth IRA, $6,500 or $7,500 over 50. SEP IRAs went up to $66,000 of total contribution for 2023 or 25% max of compensation. Simple IRAs, the COLA adjustment was $15,500. Up to a 3% match of employers, again, predicated on the change that is coming in 2024. So the simple IRA stuff is really, the window is closing on what people were really used to of the simple IRA contributions. 401ks, we'll get into a lot more of what's changed with 401ks, but basically the elective deferral, so what you're contributing out of your compensation bucket to a 401k is up to $22,500, up $2,000 from last year. An additional $6,500 catch up of salary deferral, and then up to 25% of employer match, $58,000 difference, not to exceed $66,000. So of combined total contributions. ESAs have not changed, and HSA accounts have gone up a little bit, $3,850 individual, or $7,750 for a family plan. All right. That's a good time to answer some questions. Let's see. RMD not required for Roth 401k after 2024 section 325. As far as I read it, the effect for that was immediate. Again, I need to go back and double check that. But again, I want people to trust but then verify. 604 appears to only allow employer distributions from defined benefit plans, section 604, but appears all of the plans, same old rules. Yes, the DB plan update, I didn't really feel the need to include just because we don't really get into that too much here and wanted to make sure that we hit, kind of the general mark with our audience, but really the only, change was the moderate change to some of those rules with DB plans, and then other treatment of certain types of assets with those, like treatment of private or ESOP stock as publicly traded, and some other option contract and insurance contract things. So yeah, really not too much has changed with regard to that specifically. For retirees, what is the max contribution to a Roth IRA, if any? That is up on the screen right now. Again, remembering that in 2024, we are going to have 2025, we are going to have that opening up of the additional $10,000 of contributions for the mega catch-ups. Let's see, Charles asks, is that contribution per 401k? So the 401k is a little bit odd. So you are limited to your total annual deferral of just the salary portion of it. So your 22.5 or 29,000, depending on your age. That is going to be your total like elective deferral you can make. You can participate in many 401k plans and then get the full employer match to them, but you can only contribute up to that total elective deferral or compensation match across all of your plans, kind of like an IRA. You know, you have the certain amount you can contribute over all of your IRAs, but you can participate in the non-elective employer portion of as many 401ks as you are eligible to participate in. So I hope that answered that questions. On that 401k or solo 401k, is the number the same for the Roth solo 401k? Yeah, and specific to the solo 401k stuff with Roth aspects of it, we're going to get into that, but there isn't an inherent difference between Roth and traditional or pre-tax and post-tax 401ks. The difference comes out into just your election of the taxation. So you can make the contributions either pre or post-tax, but there isn't kind of a different limitation on how much money can be added in pre or post-tax for Roth 401ks versus a traditional 401k. Great questions, but let's keep moving on. Just keep typing those in, and I will get to them as I find a good place to set up and do them. So on the vein of fundamental changes that are coming, we have simple and SEP Roth IRAs now, which is interesting. And I'll kind of pose that to people for you to make up your own minds on this. Previously, all employer contributions to SEP and simple IRAs had to be made pre-tax. So these were always traditional basis plans. And that means that for the entirety of these plans up until this point, all of these funds have been pre-taxed. Now you could do conversions of these plans, but it would immediately dump them into a Roth IRA. So you'd no longer be under the auspice of the employer plan, quote unquote. It'd be going out to a Roth IRA if you wanted to do a conversion, but every single ounce that went into either of these plans had to be pre-tax. So we're getting a ton more options with regard to what you can do with after-tax investing, which I think, again, is going to be a net positive. But what we need to look at really fundamentally here is how is this going to affect people in, one, the administration of the plans. Is this going to cause an increase in costs to the investor? And then also from the investor side of this, how does this run for you making investments within that plan? And I'll get into that as well. So this one, beginning this year, you are able to make employer contributions. The employer contributions to these plans can be made on an after-tax basis, post-tax basis, meaning that the funds can be added in directly to the plan without with the taxes already paid. Now, with a simple IRA, it's relatively easy to look at, but let's look at it from the perspective of the SEP IRA, because I think for the most part, people are going to be looking at this from the opportunity of a SEP IRA to make this. Now, SEP IRA contributions are made by the business to the plan. So effectively, the business might have to claim additional income, and depending on how people file taxes, especially for the self-employed individual, how is that going to play out for where you claim that additional income? Would it still be better? It's going to kind of offer up some more maybe tax thought for this, because do you make it after tax to the plan and then the participant converts it? Or depending on how you file your taxes, if you're filing, let's say if you're filing it as an LLC tax as a partnership, does that change, where you might want to make the after-tax contribution because the business is now going to be claiming additional income versus the participant? Do you make it all after tax, take the business right off, and then claim the additional income personally? It's, again, going to be kind of a big toss-up as to how exactly this is going to play out. And further to that, now you're going to have the potential issue of commingling pre and post-tax funds under the umbrella of one plan, which, has been kind of an ongoing issue for 401ks for many years, and there's been a lot of workflows developed for that. How's the reporting going to be done from this on an administrative side? Granted, that's for us to figure out, not necessarily for the client, but it might have the opportunity for clients to be exposed to more fees because there's more work that has to be done for these types of plans now. But from the investor side of things, what I really think might be a bit of a headache, and again, this is all, able to be overcome, and there is, dedicated workflows that have been worked out on the 401k side of things, because these types of plans have been able to take pre and post tax funds into the singular kind of pooled account for years now. But from the investor side of things, let's say that you wanted to, going forward, you had $100,000 in a SEP IRA, and now you want to start putting in after-tax money to that SEP IRA as well. Well, now you have to track the underlying basis and the net earnings attributable to both of those pools of money, meaning that if you had $100,000 of pre-tax money and $25,000 of after-tax Roth money, and you invest it all into one singular investment, well, you have to take that and say, okay, well, there's income directly related to the ratio that the pre-tax is invested and the ratio that the post-tax is invested, and then continue to track the basis of those funds when they cash out, and then you reinvest them. So you have a lot of relatively complex accounting that has to be done in the perpetuity of that plan. Now, an easy solution is to just split up the plan and have the SEP IRA pre-tax in one account and the post-tax in the other, but then that's going to break down your purchasing power of having all of your capital in one place to be invested in a uniform fashion, which there is a definite benefit to that. So, from the administrative side and also from the taxpayer, the investor side, there's definitely some, really in-depth thought process that needs to go on to really decide what the best way forward for that is. I think, again, it's going to be a net positive for people, but it's not just as easy as saying, okay, great, I can start making SEP IRA contributions after tax, blend everything up, get the right ratio of pre and post tax so I maximize my retirement savings. Yes, that is a big benefit, and that really should be the big headline that people see. But directly on the next page, people need to be thinking of, a little bit more analytically and saying, hey, how is this going to affect me down the road, and what do I need to do to make sure that I don't, overcomplicate things for myself, and I really look at this in a really drilled down and detailed manner. Another interesting thing with regard to Roth IRAs is that unused 529 plan funds can be rolled into a Roth IRA if the plan is 15 years old, up to a limit of $35,000 of 529 plan funds, but this is still going to be subject to annual contribution limits, so you can't just do it all in one tranche with a rollover. But again, additional options for getting money into post-tax retirement plans is going to be a net positive, big net positive for a lot of people. And one issue that people have run into, and the reason behind why the government did this, and they did say this in their summarization of why they put the 529 plan in there, is that the lockup of those funds is what maybe shied people away from actually participating in 529 plans, is that you have these funds kind of locked up in a 529 plan and really no available options if there are no more higher education expenses. You have a lot less of a kind of an avenue than you maybe do with using a Roth IRA for those planning, but there isn't as much contribution limit to a Roth IRA, at least there wasn't, for utilizing it for the payment of higher education expenses. So the inclusion of the 529 rollover plan is going to be, again, I think a pretty big benefit. Let's see. Okay, we got some questions. Did they change the Roth 401k where there's no RMD requirement? Yes, they did, and I'll get into that in a second. Let's see. Yeah, so Ken, to your original question, yeah, you referring to UDFI? Yeah, I do not see that, because the UDFI exemption, or unrelated debt finance exemption, is in order to protect people that are in a multi-participant plan from having the whole plan be subject to a tax that only one participant was investing in certain types of asset classes. Or disproportionately affecting because of the elections of the trustee. So they just gave a general exemption to 401k plans for the acquisition of real estate with debt financing. And I really don't see that extending over to IRAs. It's already the ability to, in the IRS's eyes, kind of inflate a tax shelter with debt financing is something that I don't anticipate being offered over to IRAs. Frustrating, yes, but I have not seen a single peep from anyone in the government about that, and I would doubt many of them are sophisticated enough investors to really even be aware of that type of exemption. So I doubt it's going to be extended over. Would it be nice if it did? Absolutely. I am championing it, but I don't think that's going to happen. But again, thanks for the questions. Everyone, please do keep those coming in. I am again happy to answer them. So moving right along, 401k changes and improvements, part 1. We have kind of a mixed bag here. And again, there are a lot more than what I'm putting up here, but it is something to really look at, because there have been some completely new changes that have come out, and there also have been some stuff that built on what the Secure Act brought into existence back in 2018 as well. So the first big headline is literally point 1 on the Senate's summary of all of these is automatic enrollment for all eligible participants at a minimum of a 3% and a max of 10%. There is an opt-out available. Now, I went into, again, kind of my personal thoughts on this, on how it might not necessarily be the best thing in the world, but it's well-intentioned. So essentially what this means is that once you are an eligible employee at a company and they offer a 401k, you will automatically be enrolled at 3% salary deferral to that plan, which sounds good. And their reasoning behind this is to help the lower wage earners, the most disaffected people, the people that have been typically, have not saved enough for retirement or just don't understand, or again, the most underserved people in the workforce, to help them plan and help them save better for retirement. However, these types of people or these types of workers are typically going to be individuals that need the most money that they are receiving. So if they're receiving $1,000 each paycheck, it is almost a guarantee that those people are the ones that need every cent in order to be able to survive, to pay childcare, cost of everything's going up, to pay for groceries, their electric bill, their gas bill, everything. They're going to need all of that. And participation in a retirement plan is a luxury that some of these people certainly just can't afford to do. But what they're trying to do is aim it and make it more automatic for people, because if they do have a few extra bucks, making it easier for them to participate in a 401k plan, because at the end of the day, this stuff is complicated. Most people understand it, let's just call it in theory, but there is whole subsets of practicing attorneys that specialize just in 401k law or ERISA law. So this stuff is very complex, and the ability for everyone to understand it and know how to properly participate is, let's just say, lacking. So they're trying to make it so that everyone can actively participate. The issue is that if people don't understand that they have been automatically enrolled in something, they see a 3% reduction in their pay, they ask a manager, hey, what is this? And someone just says arbitrarily, oh, it's the law that you're opted into participating in a 401k, that's putting a lot of emphasis on the fact that people can just then in turn understand the opt-out procedure with that. I won't get too much farther into that, but again, there could potentially be some issues, but it's well-intentioned. But I just understand there now is an automatic enrollment for 401k plans to try to help, one, ease the burden on Social Security, and also to make retirement planning easier for the vast majority of people to just automatically enroll you in that plan. Big one that I'm a big fan of, Roth 401k plans no longer have RMDs and are in line with Roth IRA accounts in this regard. I am shouting at the heavens that this happened. It was one of the things that I never understood, why there would be a required minimum distribution for money that has already had tax paid on it, because the government is not getting an additional cent from forcing you to take out of that plan. I understand why the pre-tax stuff has an RMD, because the government needs to start making tax revenue on those funds, but the Roth IRA one never understood it, and it finally, again, we're getting more uniformity out of this legislation, which I think, again, is going to be awesome for the taxpayer, in that you can say, hey, any of my after-tax stuff, no RMD. Any of my any of my pre-tax stuff does have an RMD. And going back to the beginning of this with the reduction in that RMD penalty, that's another big thing. It gives people a clear picture of what exactly they do and don't have to do. And if you had failed to take a Roth IRA RMD, now that awesome tax-free distribution that you got, you just have to pay 50% penalty in it. Now you don't have to pay at all because you don't have to take one. So again, Roth 401k RMD is getting axed. Awesome news for people. Now, another big one that I am, again, really big fan of this happening is that the IRS for so long likes to micromanage and give you exact detail on every little thing you need to do. However, when it came to making the elective deferral portion, so the salary deferral portion of a 401k, they had a best practice, call it, statement stating that in best practice that 401k elective deferral should be made within a reasonable amount of time after the last payroll has been run. Well, that's all well and good if you're a McDonald's or if you are, an Ace Hardware or Home Depot and you're paying people biweekly. But if you're a sole proprietor or a single member LLC, that's not how the world works. That's not how you pay yourself. You don't know how much money you made or how much effective, quote, income you had to contribute until probably well after the end of the year, once you figure out exactly what your accounts receivable were, what your expenses, what your tax liability payments were, because you're making quarterly payments to the tax man on that. So that didn't really kind of meld with the reality for self-employed individuals. And unfortunately, in years past, I would always have to tell people, they say, well, when do I have to make this contribution by? Well, I tell them, it's like, look, best practice, I would say, is that by January 31st, if you can at least realistically figure out how much money on the front end of that elective deferral or the compensation deferral to the 401k, that would probably be a best practice. But again, very happy with this is that the IRS has clarified this. So for single member LLCs and sole proprietors and that have a 401k plan or an owner-operated 401k plan, you have, so long as you have adopted the plan by 12/31 of the previous year, you have until your tax filing deadline to make both portions of the contribution, which again, I think will let the self-employed individuals who definitely already have enough on their plate a good degree of breathing room so they don't have to start doing a bunch of tax planning and hopefully get it right at the end of the year, or the very beginning of the year, because the other side to that coin is that, they're hoping that they make these calculations right. They may have something come through or may have an adjustment once they figure out everything, let's say in April or, closer to whenever their tax filing deadline is, that would have, let's say, negated the amount of money that they could actually add in. And now they have an over contribution scenario. And if they were invested in something that is illiquid, or let's say that had, suffered losses, they might have to, distribute that or liquidate it and then take a loss and then also, try to make that correction. A lot of undue burden being placed on the taxpayer, especially for the self-employed individuals. That was cleared up with that. So again, big thumbs up to that. And the 401k also got the additional tax treatment that the SEP and simple IRAs did, is that with regard to making after-tax contributions, now the employer contribution can also be made after tax as well directly to the plan. So we have, again, uniformity with the 401ks. Big fan that is happening a little bit more, again, with a little bit more similarities across all these types of plans, which I think will make people's lives a lot easier. Let's see. If I own my own corporation, am I required to either deduct the mandatory or due form to opt out if we are just the owner employee? So what you're getting at there is more for the automatic enrollment of eligible employees. If you are a owner-operated plan and you fall under the provisions for self-employed individuals or owner-operated plans, you automatically are immediately opted in to the participation in the plan by default. With regard to the safe harbor rule for that plan. And this is, again, something that's a good question. I don't know specifically to that question if you automatically have to enroll at a 3% and then, have form elect to opt out. The Department of Labor and the IRS are undoubtedly going to have additional clarifications as some of these questions come up and people, start challenging this and asking questions. I wouldn't think it's necessarily going to be an issue for you as the sole proprietor, self-employed individual, single member LLC. I think that they're not necessarily going to look to for that because, at the end of the day, you don't have an employee to complain because who's the employee? It's you. You're going to go complain to the IRS about yourself. So I think that's just kind of something that they're not going to necessarily care or look at, but we might get clarification, we might not. So we'll see. Does the contribution also apply to an S corp? Yes, it does. Scott asks, Section 604 allows for defined contribution plans to provide participants with the option of receiving a 25% match in funds on Roth basis. Are Advanta Solo 401k plans defined contribution plans? And if so, who pays the tax on the match that goes into the Roth portion of the plan. The prototype plan that we use for this type of contribution plan, to that question, I would say that it's something I would need to look at the underlying specifics of our 401k plan prototype document for the type of contribution definition. I want to say yes, but I also want to be accurate in what I'm telling you. Maybe follow up with regard to that, this first portion of exactly the type of prototype plan that we offer to our clients. Certainly happy to look in and get a definitive answer for that. But that comes up to the question of who pays the tax on the part that goes into the Roth portion. The same kind of thing is the issue that's going to come up with the SEP IRAs, because that is a business contribution that's being made to the plan. So who bears the burden of the additional contribution income? Is it going to be the business? Well, if it's a sole proprietor, it's already flowing through to them anyway, so does that really matter? But if it's an LLC, do you have to file a separate tax return? Is it more beneficial to make it all after tax, have the business deduction claimed, and then have the plan do an in-plan conversion and report all of the taxable income to the participant or the business owner directly? That's one that was not offered any type of clarification, and I'm assuming that is probably going to be one that is looked at and clarified probably sooner than later with regard to that. But that was one of the things that immediately made me start scratching my head is, you're allowing for after-tax contributions to these plans that were otherwise made on a pre-tax basis to the business. So you already have kind of a duality, if you will, on where taxes are deducted or paid, but there's no clarification on that. So again, that's something that's going to definitely need a lot more clarification in the coming months. And I would say to everyone on this, the likelihood of me doing a second webinar on this to, once we have some additional clarification is probably about 100%. I did it with the initial Secure Act. I did it with the CARES Act. This stuff, when it's new, we like to cover the high points. Then once we start getting some clarifications and some additional updates, I'll most certainly do at least a webinar, if not a webinar and a podcast, and we'll put out blog posts about it as well. So stay tuned. The stuff that we don't know about, we will certainly put out clarifications on, and once we get more information, we'll make sure that you get it as well. So yeah, let's see. Here we go. Okay, some of this was covered a little bit in the last slide. So single member LLCs, sole proprietors have more flexibility on making elective deferrals to their contributions to the plan. You have that plan adoption date of 12/31, and you have until your tax filing date as well. One of the more interesting things that I found was the provision on participation in employer plans if you have outstanding student loans. This is one that I definitely want to see what their clarification is of this for self-employed individuals. But in general, let's say you were working for Home Depot and you had outstanding student loans. Well, most people, the thought process is that they would rather pay their student loans down than participate in a 401k. And by not participating in the 401k, they miss the free money match that the employer is going to be making. So up into where it's most certainly going to be limits on how much you can say the participation is, but your payment of a qualifying student loan will in turn count as the participation in the plan, so that the employer can then in turn make the employer match to the plan without you having to actually put any money in the plan. So your payment to the qualifying student loan will then in turn allow for the participation in the plan to be considered, and then you to be able to receive the quote free money from the employer as if you were participating by putting money into the plan directly. I think that's a really awesome one. I know how painful it was to pay off my student loans for undergrad, and I still have friends that I went to school with that are still chugging away at those, and I'm 34 now, and I have friends that are older than me that are still paying off significant student loans, and I would assume that they have not participated in their retirement plans as much as they should have. So I think that this is going to be a really awesome benefit to people to try to help, clear up the, I guess I would say generally thought of massive issue of student loan debt in this country, while letting people, focus on that and also save for retirement. I think that's going to be a really great thing. Going to be kind of interesting, again, to see how that plays out for people with sole proprietorships or single member LLCs as to, how you can maybe play with that and get an additional benefit of maybe paying down that type of debt while still also deferring revenues from the business in there. Again, I don't know how many people that's going to affect, or if it's even going to affect enough people for the IRS to say anything about it, but it's still worth kind of posing the question. Another really good benefit I think that came out of this, that's a little bit more off the beaten path of the highlights that I wanted to cover, is that you are now able to self-certify hardship withdrawals from a 401k plan for a wide variety of instances. This essentially is a carryover from provisions that had expired with the CARES Act. There is a lot of things that went into that, to be able to self-certify these types of hardships, because before you used to have to, prove disability, kind of like getting a disabled placard hanger for your car. It's, a pain to do that. And they're trying to make that burden a lot easier for people, because, people, if the past 2 years have taught us anything, is that there's a lot of hardship going on in the world, and the ability to access capital for living expenses, business expenses, anything that is a hardship to you is probably something that should be protected and codified, and this does that. So I think that's a really, really awesome thing that they did. And then also, I included one that I found kind of interesting, because the government literally typed in a creation of a lost and found network. How can you not explain that if you read that in some, convoluted tax legislation? Essentially what they're doing, and I think this, again, is going to be a benefit to people. If you've changed jobs, or you've had jobs that have, let's say you changed a job and your old employer got bought out or went out of business, X, Y, or Z, finding those old retirement plans can be a royal pain. And I've had people that have actually, had issues with that, and we've tried to help them to that effect as well. So they're going to be creating a national database that 401k plan administrators are going to have to register with when they have active participants. So that way, if you have changed jobs, have old 401ks, you have a database you can go into, put in your information, and find how many different retirement plans that you have that are out there. Now, I would think that the IRS, because they get all of these things reported to them anyway, probably already has a framework for that. So I don't understand why it necessarily took this long to figure that out. You can't just ask the IRS, say, hey, how many retirement plans do you have reported each year that are, under my name? So again, there is some disparity on the actual reporting and the information that the IRS and Department of Labor get with regard to employer plans that have many employees. You don't always get, list of the underlying employees. Sometimes it's a general plan report like 5,500 and the like. So with that said, I hope people found this interesting. I am looking forward to not looking at tax legislation for a few more days, considering it's been what I've read in the morning, over lunch, and at night for the past week and a half. So I hope people got some good information out of it. Keep in mind that this is going to be inherently dynamic over the next coming years and months, and we will most certainly put out additional information and clarifications as they come out from the IRS. Again, I think it's going to be a net positive for everyone. I hope everyone, can take advantage of this to, the maximum that they, certainly can. And if you have any questions, feel free to reach out to me directly. I am certainly happy to help with that. I'll stick around for a few more minutes. If there's anyone that wants to fire off any questions or clarifications, I am more than happy to answer that. But, it's 12:55. I'll let everyone get back to their day. I hope everyone, again, got some good benefit out of this. And, I hope this has nothing but positive effects for you and your retirement plans and savings and everything else. So again, thanks for being with us today. Question before I end this: is a traditional IRA conversion considered a contribution to a Roth? No, you can convert any amount of money in a pre-tax traditional IRA to a Roth, and it does not count against any available Roth IRA contribution limits that you may have. So you can still make the Roth contribution. You can convert $250,000 of pre-tax plan assets to a Roth IRA and still plug in a $6,500 or $7,500 Roth contribution that same year as well. Has no effect on that.